Greetings from Houston, Texas. I'm very honored to be selected as the keynote speaker for the Sri Lanka Institute of Information Technology conference on advancement in sciences and in the humanities. I wish you a wonderful conference. And again, thank you for the opportunity to share my work. Today, I'm going to be talking about computational finance, correlation, volatility, and markets. So what we'll cover, we'll do a general discussion of the role of modern statistics in financial markets, talk a little bit about financial time series and the role of volatility. Then we'll move to the modeling phase, which is really where my contributions are, ultimately building up to this hierarchical regime switching, a dynamic constant correlation multivariate Garch model, which is quite a mouthful. And then we'll apply that model to three financial sectors from the U.S. markets and give an example of anomaly detection. So I'm going to share this quote from Steve Lohr's New York Times 2009 article. It's a little dated, of course, but it was a prediction, and did the prediction hold true? So the quote is, "I keep saying that the sexy job in the next 10 years will be statisticians," said Halvarian, chief economist at Google, and I'm not kidding. Well, that's definitely been true. We've definitely lived this over the last 10 plus years, and the contributions that we bring to the world are just phenomenal. So, in fact, much of today's global prosperity can be attributed to the intelligent use of modern statistics in manufacturing, product development, high global construction and infrastructure as we look toward resilient communities, drug discovery and patient care. We certainly saw that through COVID and the pandemic. And just in general toward healthier societies and healthier communities. But most certainly in our topic today, global financial markets. So let's just give some highlights of modern statistics and investing. So investing on what scale? Are we annually rebalancing to algorithmic trading where computers are trading with computers at the nanosecond? In general, modern portfolio theory relies on the first and second moments and factors whose first and second moments are considered. It is no longer modern, but is it still useful? And is this even less true given the market dynamics of today? The nanoscale definitely impacts the macro scale. And how can we take that into account? Can one overcome the basic limitations of modern portfolio theory with a proper implementation of modern statistics? So in short, if we can better model the markets, the financial markets that is, can this lead to actionable information? And of course, I believe that that is the case. But simple is not the solution. So many simple approaches rely on old-style statistical methodologies whose limitations are also not well understood. Consider a macro-level problem based on global investment. Convergence of global markets, typical strategies did not properly account for the decreased diversification. So over here in the graph, I show the correlation of percent returns over time based on across different countries, and when I'm comparing to Europe. Typical regression strategies led to underestimated value at risk. If you use quantile regressions, you can adapt to that changing correlation structure. So this is from a 2009 paper of mine and my co-authors. But the bottom line is just these simple calculations led to a 50% underestimate due to political risk, or a 500 million project was underestimated at this level. Systemic risk and market structure. We cannot regulate away systemic risk. We can only change its form. So systemic risk is the risk that basically is systemic throughout the system. If we see the collapse of one sector, will we see all sectors collapse? If market structures change, I am reminded of Pareto's chart used so well in quality control across the world. highlighting the most common sources of defects. Understanding the degree of global market dependence and systemic risk is key for all investors, regardless of their investment style, and diversification is always a moving target. A very common and well-known observation now is the convergence of many financial instruments as markets collapse. For example, if we look at just basic hedge fund strategies, the goal was to come up with diversified strategies. So the plot on the left shows the correlation of a long-short equity strategy versus the US S&P 500 index. And we see that the correlation really hovers quite high, ranging between basically a quarter and looks like about 0.8, 0.9. Another example was a multi-strategy hedge fund. And again, looking with the S&P 500, we see that as markets collapse and grow, this correlation over time changes dramatically. So looking at this a little bit differently, and so this is a paper of 2011. So we just broke up, we looked at hedge funds and just broke them up into 3 different time periods. And so these network plots showed illustrate the degree of correlation between the hedge funds. So the red lines means that you have a positive correlation greater than 0.5, where black is a negative correlation, which would be less than negative 0.5. And what you see is in the third period, which is July 2007 to April 2011, that we see very strong correlation across all of these hedge fund strategies, where we did not see that in the time period of 2000 to 2004, or basically April to December of 2000. So what is a quantitative investor to do? Should we just ignore the market microstructure? This is one of the struggles that we face in quantitative investing. So there are some solutions, and really this is where the power of modern statistics really comes in. So we can use robust strategies that are not impacted by this changing structure. We can properly incorporate the essence of the dynamics into factor-based models. We can rely on law of large numbers and central limit theorem and continue business as usual with modern portfolio theory. We can target stable time epochs to place longer-term positions, or we could develop some model-free strategies that capture the dependent structure between stocks, which is the invention of one of my former colleagues, Jim Thompson, and the semiogram. But what I'm going to talk to you about is developing a dynamic, robust time series strategy that fully captures the changing market structure. And that's if you can, but I claim that we can. But most certainly, we can rely on modern statistical methods, but we need to fully understand the limitations of the array of the methods used and maintain a healthy dose of skepticism in our application of these models. Just to illustrate really quick that forecasting is feasible. So this is, I haven't introduced what volatility is yet, which I'll do in just a moment. But if you can see, this is the red line is a very simple forecast of volatility, and you can see that we're capturing the market dynamics very well with that forecast. So we know that there is hope that we can model this well. So let's get a little bit specific here. So what are we actually considering? And so I know, again, many of you don't necessarily study financial time series. So let's see what we actually have. So I just grabbed an exchange traded fund, ETF. And the one I chose was DBBR, and it's designed to hedge against drops in Brazilian currency. And this is just an illustration of this idea of prices, returns, and squared returns. So in the top graph, you notice that these are the prices of that exchange traded fund, and these are daily prices. Okay, so then the returns are the relative price change. So today's price minus yesterday's price divided by yesterday's price. And so that's the relative change in the day-to-day price. And the returns are actually what we model. And so you can see that they have some really interesting dynamics. And if you jump down here to the third graph, we're just going to square those returns. And so we're trying to get at that volatility component. And you see that there's quite a bit of different behavior in these squared returns over the time period that we chose. Let's take another example. So this is the exchange rate for the current Brazil to US exchange rate. And so the exchange rate is the top graph. And then the returns, again, just taking today's exchange rate minus yesterday's and dividing by yesterday, so the relative change. And so we see in this period that there's a lot of volatility in these returns during see, what would that be? That looks like it's about 2007 time period. And then if we square these returns to understand the volatility, again, we see those inflated values. So it's this, so the returns, the middle graph, and the squared returns, or the volatility, is what we actually want to try to model with our dynamic time series. So what is volatility? We define volatility as the conditional variance or standard deviation of a time series process, but it's not directly observed. So this is always my question for my time series class. The question is why? And the reason is because we're each day we take one observation, and we cannot estimate a variance with one observation, but we can model that variance. So common features of volatility, the time series will be serially uncorrelated, but it's still a dependent process. It is stationary. We generally see clusters of low and high volatility, and it tends to evolve over time with jumps being rare. And it's generally asymmetric as a function of market increases or decreases. So let's think about how we might measure and model volatility. So historical or realized volatility, if we're trading in the stock market, the tick level data is every actual trade that takes place. And so those take place at sort of nanoseconds. And we can use the tick level data to estimate daily variation in returns across the day. We could use daily data to estimate monthly or annual volatility. There's also something called implied volatility. So if you study financial markets and you study options pricing, the implied volatility would be the parameter estimate from the Black-Scholes option pricing model. But what I want to do is I want to model volatility. And there's two basic classes of models for volatility. One is the set of time series model called ARCH, GARCH, eGARCH, DJR, GARCH. There's a long list of models in this class. And then the second would be a stochastic volatility model where the volatility evolution is driven by a stochastic equation with additional error term. So I use both strategies regularly, and then but today's talk is focused on the GARCH set of models. So let's talk about modeling our returns and their volatility. So I am going to throw the math at you, and happy to share these slides. This is all taken from a 2014 paper of mine that really outlines all of this and gives you all the details. So these YTs here would be our returns. that we defined earlier. And so they're going to have a mean that's going to be a function of a set of parameters and then some additive noise. And this additive noise epsilon will then be modeled in this way. So here ZT would be, for example, a normal 0, 1 random variable. And so that sigma t captures the changing structure in that error process. And so you notice that we're going to come down here. So that's basically our standard deviation that's evolving over time. And we're going to come down here and we're going to model this standard deviation, except for I'm going to model the variance. So this is my model of the variance. And so that model of the variance is going to have some constant plus some lagged values of the squared returns, plus some lagged values of this variance itself. So this is the Garch model. And of course, there's constraints on these parameters so that we ensure that the variance is actually positive. But so modeling the daily volatility, which is this variance or standard deviation of an asset, is an important step in estimating how much risk a particular asset carries. Again, variance is not directly observable from a time series because we measure only one observation each day. So all of this work came from the seminal paper of Engel in 1982 on autoregressive conditional heteroscedastic modeling. So those were the very initial first models. And in 2003, he was actually awarded a Nobel Prize in economics for this invention. And so the generalized Garch models has seen a strong evolution over the last 50 years. And so we consider this Garch model as our starting point of our discussion. So let's, when you win a Nobel Prize, there's lots of things that you can do. And so Engel and his collaborators at NYU, Stern Business School, have established this VLab, which is Volatility, stands for Volatility Lab. And so you can enter any stock, any index, any entity, and it'll give you immediate output in terms of the price, the returns, and your Garch estimate. And you'll notice here there were many different choices of a Garch estimates, Garch models to use, and that just demonstrates how rich a class these models are. So I actually just applied this to the Sri Lanka Colombo Stock Exchange index, and so what you see here, and this gives the immediate output for 2 years worth of data. So this green line here is the price of the index. These blue lines would be our returns. And this red here is our Garch model for those returns and their volatility. And so we see that strong changing volatility captured in this Garch model. So I encourage you. So I really do encourage you, if you're at all interested, to play around with this website. I find it absolutely fascinating. Let me, skipped a slide. I think I have one more in there. Okay, so I just did the same thing, but I chose 10 years worth of data for the Sri Lanka Colombo Stock Exchange all share index. And so you can see again the green line and the subplot is the actual price of the index. The blue line are the returns, and the red line is the modeled returns and Garch process. Okay, so let's step up a level. So markets are multivariate, and the variation is key to pricing. So we're going to take, so this plot is just 10 sectors, top 21 stocks in each sector, and its daily stock returns. And so what do we notice about the variation? So, I've just shifted the each sector so that you could see the differences. And so, you're not supposed to really get specifics from this plot, but I'm hoping that you can get some of the details. So it definitely, the dynamics of the market definitely change over time. They are asymmetric. The cross sectors variation is correlated. So we see, the like large spikes bleeding over and across. We also see correlation here across the market sectors. And then within sectors, variation is correlated as well, although you can't really pick it up too well from these plots. So how can we capture these features in our demonstration? So now I'm going to start building up these models, and so we're going to go from this univariate Garch model to this multivariate Garch model. And so again here, so now Y is K dimensional. So I have K time series. And so then mu will be K dimensional and epsilon will be K dimensional. And so then I'm going to model the multivariate noise process epsilon by the square root of this H matrix times a multivariate standard normal ZT. And so this is used for studying the relationships between volatilities and co-volatilities for multiple stocks. And if I refer you back to my paper where we highlight this just exceptional survey provided by Bowens in 2003. And if you want to actually try these in practice, then there's a great R package for this RM Garch. But the key will be modeling H. So here's just a few more details. It basically says the same thing, but it also imposes the restrictions that Z is zero mean with identity covariance matrix. And so if you jump down to the bottom line, bottom set of information, so H, the square root of H is our K by K positive definite matrix. And then H is the conditional covariance matrix of Y, again, conditional on the information of the process up to time T. So MGARCH challenges and solutions. So the challenge, the number of parameters grows with K, so K squared. Variations in MGARCH models result from how one approaches modeling of H, that conditional covariance. So one of the first simplest ideas was the constant correlation model, where we fix the correlation between assets. So that actually remains constant, but then we allow that their individual standard deviations to change over time, and we model them with the univariate Garch model. And so then we recover the covariance matrix with the correlations and the models of the individual standard deviations. So for example, just getting the details here, so H then becomes DTR dt, where D is the diagonal of those individual standard deviations that we're modeling. And then R is our constant correlation matrix. And this is an extremely useful model, and one that you should always try at the beginning. But now what we'd like to do is we'd like to actually allow the correlations to change over time. So we're going to subscript R in that way. So then we would start trying to model R, and you don't really, the details of this slide aren't that important. I include them for completeness in case someone is actually interested. But the idea is the correlations will evolve by some fixed model over time. So if we go to the market-dependent regime switching dynamic correlation model, what we're going to hypothesize here is a system is constant within blocks of time, but change with key market dynamics. So this allows for time-varying correlation between the series by allowing the system to switch between regimes. The covariances in the system are decomposed into correlations and standard deviations as before, and the correlation matrix follows a regime switching model. So again, here are the details. So we're modeling H here. And H, this gamma is our correlation matrix. And then it has this regime switching feature that we've introduced. And so this delta T will be a Markov process, which can take R possible values. But in our example, R will be 2. But so basically, we're switching between fixed correlation matrices as the dynamics of the system change. So we're going to assume that the Markov chain is ergodic and irreducible. So our focus is understanding the co-volatility of sectors of stocks and stocks within sectors under different dynamic regimes. So in short, estimation is a multi-step process. So this is a hierarchical model. So we're going to estimate the univariate volatility models using an asymmetric power arch model. So one of those Garch models, but we want to be able to capture different upside and downside volatility. We'll implement a maximum likelihood, assuming constant correlation across the K regimes using the EM algorithm. And because the Markov chain governing the regime change is unobserved, we'll make use of the particle filter. And again, all of this is detailed in the 2014 paper. So let's look at this in action. So that's all the theory. So now let's, I tried to show enough so that you could maybe grab hold of some of the key pieces and then investigate if you're interested. But now let's actually look at how we might apply it. So what I'm going to do is I'm going to, I'm using US data. It's very easy to get US data. And I'm going to take the three sectors, the financial sector, the energy sector, and the technology sector. And what I've plotted is just daily returns from January 3rd through May 31st. So you can really see some of the dynamics going on of 2000. This is all relatively old data, but the story stays the same. And so if you look at the financial sector, you can see that it's really moving together, whereas the technology sector has a little less correlation over time. But then the question is how are they also relating to each other across the sectors? And again, these are the daily returns that I'm plotting. So let's look at it a little bit more closely. So this is just, I think, 1 week's worth of data. And so it's the same information. And what I'm trying to depict here are the high and low correlation regimes. And it's a little hard to see, but these correlations are all 1. And then these are closer to 0. And so we see that those daily correlations change, and those are the probabilities of being in the high or the low. So if I look at this across sectors, so here's my matrix of the changing correlations, and so the diagonals are the within sector correlations. So I've got energy to energy here, and then finance to finance here, and then tech to tech here. And so that's the correlation within each sector. And then the off diagonals are the correlations between sectors. And so we see, if we look at the energy and tech sector, we see very little correlation, but it does change over time. The correlations across sectors are generally low, but approach 0.4 between the finance and tech sectors. So now we have a model, we have a method of estimation. Let's do our due diligence and make sure that we can actually implement this model and come up with strong parameter estimates. And we are able to do that. And so what I've depicted here, so these are the true correlations from the model that I'm simulating, and it's just modeled after what I saw in the case study that I presented. And notice here that the estimates for regime 1 are very close. Again, here's the true correlations for regime 2, the high correlation regime. And again, the estimates are very close. And if we come down here to our parameter estimates for the univariate volatility estimates, we again see that we have very strong recovering of our parameters in our simulated data. So now that we know, we've hypothesized a model that we believe really captures the dynamics of our system. We know that we can fit it and come up with good parameter estimates. So let's actually put it into a practice. And so the final model, the final fitted model, is actually very succinct, but it's very powerful. So notice that I'm capturing estimates for both of the regime probability matrices, but then I'm also capturing all of the parameters for the univariate volatility. And here I've allowed for heavy tails through the T distribution and skewness, as well as many of the parameters that we want when we're modeling volatility. So so now we have a fitted model. So what are we going to do with it? So one thing that we can do with it is this anomaly detection. And so our fitted model can be used to obtain a one-step, and by one step in this case, it's 1 day, ahead forecast of the covariance of the markets. We could forecast out further, but with that Markov chain going on, we might not do as well a couple of days out. The forecast is comprised of this weighted average between the high and low regime correlation matrices, and the weights are given by the predicted value of the Markov chain. And then also the forecast of the univariate standard deviations. So that gives us a mechanism to forecast the actual covariance for the system. And so then we can apply principal components of the predicted covariance structure to get an insight for the overall market structure. And then the evolution of these principal components directs us to unusual events such as a market crash or stock price anomalies. Identifying such structural changes can identify favorable market conditions for trading. Maybe you want to short a stock or you want to get out of it altogether. So we're going to demonstrate this using biplots, which are derived from the first and second components of the principal component, as they're a good way to understand the visual change in the principal component structure. So let's take the collapse of Enron in 2001, which led to a global collapse of financial markets, ultimately. And so on October 16, 2001, Enron announced non-recurring losses of approximately $1 billion. Our daily biplots first detect Enron as an outlier on October 4th. Okay, well before that October 16th. At the end of October, the two leading credit agencies downgraded Enron, and then ultimately they filed for bankruptcy in December. The competing state-of-the-art statistical tools pinpoint the problem on November 28th after junk status is achieved. So that's not useful, but our method is useful because we clearly highlighted the problem, foresaw the problem on October 4th. Another example is silicon graphics. So an anomaly was detected on June 2nd. And so we went back and we reviewed, and this is all done in a forward fashion. So I'm not using data after June 2nd to identify this. But to understand what's going on, we went and looked at the the SEC filings, and we see on June 9th, they had a spinoff of the company. So the filing was made 1 week after we identified SGI as an outlier in terms of its behavior concerning the system of stocks. So there was some early trading around that information, and legally that shouldn't be done, but our system allows us to pinpoint these things. So we in our retrospective study, we identified 16 anomalies, 13 of which we were able to verify through SEC filings. So in conclusion, the use of multivariate co-volatility models is commonplace in financial time series. Coupling the multivariate Garch models with Markov chains to capture regime changes is a powerful tool for modeling complex financial market dynamics. The nowcast and forecast of the co-volatility informs trading of equities. Using PCA of the nowcast and the forecast of the multivariate market covariance structure identifies unusual movement in the price structure of individual assets. Computing for this rich class of models is readily available through R and the packages RU-Garch and RM-Garch. And with that, I will give a heartfelt thank you for your time today and listening to my ideas. I hope that you find them useful, leaving you with a beautiful picture of Houston so we can have a little bit of country to country exchange here. And once again, thank you for this honor of presenting at your conference.